Welcome back to Smart Stock Sam, the channel built for traders and investors who want clarity, not confusion, when the market moves fast. If you caught our last breakdown on this exact ticker, you already know what is coming, because everything we mapped out back then just played out almost to the dollar. Today, we are tackling the only question worth asking right now. Is HIMS and HERS Health a buy, a sell, or a hold heading into this week? We will walk through the breakout that just shattered a wall of resistance, the legal settlement and billion-dollar acquisition fueling it, a hidden options mechanic that is mathematically forcing Wall Street to keep buying shares, and a short squeeze that is quietly bleeding hundreds of millions of dollars out of the bears. Stick with me, because by the end of this video, you will have the exact entry zones and price targets that could shape how you trade this stock for the rest of the week. Just days ago, this stock violently shattered a massive psychological ceiling, surging more than 12% in a single session to close at $30.17. This was not a random meme stock pump. This was a calculated fundamental explosion, and by the time we are finished today, you will understand exactly why so many traders are now asking whether this is only the beginning of a much bigger move. But to understand how powerful this breakout really was, we need to rewind the tape to the setup that made it possible. If you remember our last forecast on this stock, we drew a hard floor right at the 200-day moving average, sitting at $26.09. That moving average is where institutions tend to step in, separating long-term bullish trends from bearish ones. And exactly as predicted, this stock tested that exact floor and held it with real strength. Then came what we like to call the sentinel signal. The lead director of the company walked into the open market and personally bought more than $1.1 million of his own company stock. When insiders buy heavily at structural support, that is not noise, that is a message. But the real final boss for this stock was $29.53. Why that specific number? Because that is the exact conversion price tied to the company's $350 million convertible senior notes. It acted like a concrete wall because institutions naturally take profits there to manage their own debt conversions. For weeks, the stock could not break through it, until June 15th, when it ripped straight through, securing a massive 12.49% surge in a single day. But this was never a straight lineup. In fact, just one trading session earlier, the market tried to lay a trap for retail traders. On Friday, June 12th, the stock plummeted more than 7%, closing at $26.82 on 19 million shares of volume. Financial media was spinning a deeply bearish story: broad market profit-taking, fears over margin pressure in the weight-loss drug space, and political noise from a sitting senator pushing the FDA to investigate the company. Retail investors panicked and sold, but smart money read it differently. One session later, on Monday, June 15th, the stock completely shrugged off the political noise. Helped along by broader macro tailwinds and an aggressive wave of short covering, buyers stepped in with more than 22.8 million shares of volume. They did not just retrace Friday's drop, they obliterated the resistance level entirely. So here is a question worth sitting with. What happens if that kind of violent reversal repeats itself again this week and the bears get trapped a second time? Technicals alone never tell the full story, so let's look at what actually changed under the hood. In just a matter of weeks, this company went through a four-pillar transformation in its fundamentals that completely de-risked the business while expanding its growth runway. First, legal defensibility through a major lawsuit settlement. Second, aggressive scaling through a massive acquisition. Third, a strategic pivot toward recurring, proactive care instead of one-off treatments. And fourth, a brand new multi-billion-dollar market opportunity opening up in front of them. Each of these pillars on its own would matter to a long-term investor. Together, they completely reshape the valuation story, and they help explain why so much capital rushed into this stock at almost the exact same moment. Let's dig into that first pillar, because it is arguably the single biggest catalyst behind this entire rally. For months, a dark legal cloud hung over this company, a patent infringement lawsuit from a pharmaceutical giant over the mass marketing of compounded weight loss drugs. Wall Street hates legal uncertainty more than almost anything else. But, in a strategic masterstroke, management voluntarily halted their compounded marketing. In exchange, the pharmaceutical giant dropped the lawsuit before it ever needed a motion to dismiss. The company immediately pivoted to become an authorized distributor of the branded version of the very drugs it was being sued over. They turned their biggest legal threat into their biggest supplier relationship. The shift was so decisive that a prominent short seller who had actively bet against this stock was forced to publicly admit the company's leadership had completely outmaneuvered the larger pharmaceutical giant. When the people betting against you start complimenting your strategy, you know the narrative has flipped. And management did not stop at fixing the domestic supply chain. While the market was still distracted by that legal drama, the company quietly closed a massive $1.15 billion acquisition of an Australian digital health platform, closing it a full month ahead of schedule. This was not a small bolt-on deal. Overnight, the company expanded its footprint into Australia, Japan, Germany, Canada, and the United Kingdom, absorbing more than 850,000 active customers into its ecosystem. That wave of new recurring users directly supports leadership's aggressive long-term targets. Management is officially guiding for $6.5 billion in revenue and $1.3 billion in adjusted earnings by the year 2030. This is no longer a quirky startup selling hair loss treatments. This is a company building a global consumer health empire, and most of the market has not fully priced that in yet. But the future is not just about geography. It is about pioneering an entirely new category of medicine. The next frontier here is a strategic pivot away from episodic treatments and toward recurring, proactive longevity care. The company recently brought on a new chief medical officer specifically to lead this charge. The core of this pivot rests on peptides. The FDA is scheduled to review compounding restrictions on 14 different peptides on July 23rd and 24th. Analysts estimate this could unlock a $20 billion total addressable market. Now let's do the investor math here, because it matters. This company already has the domestic manufacturing infrastructure built out, which means it can scale almost immediately. For every single 1% of market share it captures in this new peptide category, that translates into roughly $200 million of incremental revenue. That is the kind of scalable growth that gets long-term investors excited. So here is a question worth asking. What if this peptide opportunity ends up being bigger than the entire weight loss business that built this company in the first place? Now, hearing all of this, you might be wondering, if everything sounds this well executed, why did the company just report a financial loss? Let's look at the actual numbers. In the first quarter of 2026, the company reported revenue of $608.1 million, a solid 3.77% increase year over year. But the headline that scared retail investors was a $92.1 million net loss. If you only read the headline, you would think the business was bleeding cash. But sophisticated investors read the footnotes. A large chunk of that loss, roughly $33.5 million, was a deliberate, one-time inventory write-down. Management purposefully took that hit to exit the controversial compounded drug space and lock in that vital partnership with the pharmaceutical giant we talked about earlier. This loss was the price of admission for long-term legal safety, not a sign of structural decay. And if you want proof this was the right move, you do not have to take our word for it. You just have to look at how Wall Street reacted. Following this pivot, major institutional analysts rushed to rewrite their models. Barclays raised its target to $29. Canaccord Genuity raised theirs to $32. JP Morgan set a bullish $33 target. And Needham took the crown, upgrading the stock to a buy rating with a towering $35 price target. We now have an established institutional target zone sitting between $33 and $35. When the major banks are universally raising their targets, that is effectively a green light for their institutional clients to start accumulating shares. And it tells you the legal overhang that scared everyone for months is now firmly in the rearview mirror. Talk is cheap on Wall Street, though. If we want to see where real conviction lives, we have to follow the money. Institutions currently hold more than 171 million shares, controlling a staggering 76.68% of the entire float. Large funds have been aggressively adding to their positions in recent weeks. But the single most bullish data point here is insider conviction. Remember that sentinel signal we mentioned earlier? The lead director did not just exercise options, he went into the open market and bought 48,400 shares with roughly $1.17 million of his own money at an average price of $24.23. Insiders sell stock for a dozen different reasons: buying a house, paying taxes, diversifying their wealth. But they only buy for one reason: they believe the price is going higher. So the fundamentals look strong, and the insiders are buying, but what are the algorithms seeing right now? Technically, this stock is flashing a strong buy signal across nearly every time frame. It is currently trading above its 5, 10, 20, 50, 100, and 200-day simple moving averages. That means no matter which time frame a trading algorithm is programmed to watch, the trend is undeniably pointing upward. The MACD, which measures trend momentum, sits at a healthy 0.57. But perhaps most importantly, the 14-day Relative Strength Index is sitting at 62.48. In plain English, that means the stock has real upward momentum without yet drifting into overbought territory. There is still runway left before this trade gets exhausted, which raises an interesting possibility. What if the strongest part of this move has not even happened yet? Now here is where it gets really interesting, because none of this matters if we ignore who is on the losing side of this trade. Right now, there are 62.61 million shares sold short on this stock. Depending on which metric you use, that is somewhere between 29% and 42% of the entire tradable float. That is an enormous, heavily crowded short position. The days to cover ratio sits at 4.08, meaning it would take short sellers more than 4 full days of non-stop buying just to exit their positions. They are trapped. When the stock broke out, it inflicted an estimated $546 million in single-day losses on those short sellers. When the bears lose that kind of money in one session, they panic, and panic forces buying, and buying drives the price even higher, squeezing out even more shorts behind them. So what happens if even a small percentage of those trapped shorts are forced to cover at once, all in the same trading session, with nowhere left to hide? Making matters worse for the bears, the options market is pouring fuel directly onto this fire. On the day of the breakout, more than 171,000 options contracts traded, and an enormous 71.08% of them were call options. Total open interest has swelled to 1.11 million contracts. Here is how the mechanism works. Traders buy a massive wave of call options. The market makers who sell those options suddenly carry real risk if the stock keeps climbing. To hedge that risk, those market makers are mathematically forced to buy shares of the underlying stock. That forced buying pushes the price higher. The higher price attracts even more traders into buying calls, which forces the market makers to buy even more stock. It becomes a self-reinforcing, almost mechanical feedback loop that can push a stock upward regardless of the underlying fundamentals. And once it gets going, it tends to feed on itself far longer than most traders expect. With that engine running hot, what should you actually be watching to make sure this trade does not blow up in your face? On the short-term tactical side, keep an eye on the put-to-call open interest ratio, currently sitting at a bullish 0.65. Watch borrow fee rates closely too, currently low at 0.45%. If those borrow fees suddenly spike, it usually means short sellers are running out of shares to borrow, and the squeeze could be accelerating. On the longer-term strategic side, the single most important metric to track going forward is subscriber retention. The company is transitioning users onto the branded version of these drugs, which costs roughly $149 a month. We need to see whether that higher price point causes meaningful customer churn. And later this year, we will need to verify that the recent acquisition is actually delivering the margin expansion management has promised. None of these metrics are flashy, but they are exactly the kind of details that separate traders who get caught off guard from traders who see the next move coming. So what is all of this actually worth right now? Let's map out the trade setup for the rest of this week. The old resistance level we talked about earlier has now flipped into the new baseline support. The ideal entry zone for intraday pullbacks sits between $29.50 and $29.80. If the stock dips lower than that, the next psychological safety net sits at $28, and the ultimate structural floor remains the 200-day moving average at $26.09. On the upside, expect some historical friction right around $30.50. But with the options engine running and short sellers bleeding cash, the primary squeeze extension target sits at $32. And if accelerated, panicked short covering kicks in heading into the next options expiration, the next stop could be that institutional target zone between $33 and $35 set by JP Morgan and Needham. So here is the real question heading into this week. Does this stock quietly consolidate at support before its next leg higher, or does the pressure from trapped short sellers force an early move well before anyone is positioned for it? Before you go place a single trade, a quick but important reminder, this video is for educational and informational purposes only and should never be treated as personalized financial advice. Stock prices can be volatile, short squeezes can reverse just as fast as they build, and past performance is never a guarantee of future results. Always do your own research. Think carefully about your own risk tolerance and consider speaking with a licensed financial advisor before making any investment decision. Now, with all of that said, here is what I want to know from you. If you had to pick one single metric to watch most closely this week, the short interest data, the analyst price targets, or the options flow, which one would you trust the most, and why? Drop your answer in the comments because some of the best insights on this channel come from you, not from me, and I genuinely read through as many of them as I can. If this breakdown helped you see this stock more clearly, do me a favor and hit that like button. It genuinely helps this channel reach more traders who need this kind of analysis. And if you have not already, subscribe to Smart Stock Sam so you never miss a breakout before it happens. If this video saved you time, money, or a bad trade, consider sending a super thanks using YouTube's support feature. Every bit helps this channel keep producing in-depth, research-driven content like this. And finally, if you are serious about leveling up your investing and trading game, come join our channel membership. Inside, you get access to an exclusive community built for traders who want deeper breakdowns, earlier alerts, and priority replies to their questions. Trade the levels, manage your risk, and I will see you in the next one.